Hello, investors and traders, and welcome to the weekly market report. I'm AJ Monte, Chief Market Strategist with Sticky Trades, and we're coming into the final minutes of the final day of the final week of the final month of the year, and I am pumped about 2024. I hope you are too. Hopefully, you've had a chance to follow me on Twitter. I'm just going to pull up my X page, formerly known as Twitter. And for those of you who are following my SLV trades, you can see here that yesterday I put out a post letting everyone know that I would be selling at a 5% more of my SLV position. And I posted this chart with notes. You could also see that on this chart, I put a price target of 21.5. And today we came within 6 cents of that. You can see here from the SLV chart that we came within 6 cents of that target, but I do believe we'll hit that target next week as the CCI down below, as I magnify that, you can see that it's crossed down below the zero line. Now, generally, that's a big word, right? Generally, when that line crosses, you get a 2 to 4 day additional move in the direction of that cross. So we might even blow through that downside target of 21.5, which would not upset me at all because I'm looking to buy back all of what I've sold and more down around the $21 level. So if you are interested in following my trades, whether you're trading along with me, ghosting with me or not, you could at least learn how I'm using these charts. And all you have to do is go on X and use hashtag AJSLV trades, and that will bring you to the history and all of the posts that are associated with my silver trading. And some of you know my background. In 1982, I came down to the COMEX, the commodity exchange floor, and I started off at the very bottom of the rung on that Wall Street ladder, and I worked my way up to become a trader. And so silver is something I've been trading for over 42 years. It was actually August 15th, 1982 that I stepped foot on the trading floor. My uncle was a commodity trader on the coffee, sugar, cocoa exchange. So we had that DNA going in the family. And I'm very familiar with silver. I'm very comfortable with it. Again, if you're learning how to trade, it's a great way to just practice using paper trades. And then because it's cheap enough, if you have a little money in your account and you feel comfortable, you might decide to follow the charts and dig in to the silver trades with me. So before the market closes, I just want to show you a couple of things. Looking at this slide, you can see it's the 7-point trading checklist. All of our members use this on Wednesdays, especially during the rapid fire stock analysis session. What I do is I use that trading checklist very quickly, and I go through 50 stocks, at least 50 stocks in a 60-minute period. And last Wednesday, we went over 55 stocks in 62 minutes. I went 2 minutes over, but I think it was worth it for the members who attended. And we picked 26 star favorites. Now, what is a star favorite? Well, if I go back to that trading checklist, a star favorite is the best of what we see on that checklist. So if we have an overwhelming majority of the signals going bullish, that will be a star favorite to the upside. If their signals are showing more bearish than bullish, overwhelming evidence showing that, then what I do is I label that as star favorite to the downside, and then I put my targets. And we have a third-party researcher who uses a program to track the hit rate. For a 2-year period, 76% of the targets that I set using my 7-point trading checklist hit over a 66-day period. Now, that's 66 trading days. That's how the program tracks that. Now, that's extremely valuable for option traders because it gives them a window from which they could pick the expiration dates on their trades. Now, whether you're an option trader or not, I think it's a good idea to use the charts, not just for forecasting, as we show that this is evidence that the charts do work, but for more of a risk management tool, I think the charts will be giving us most value for 2024, because I think that with my bearish outlook, I'm starting to see a lot more evidence that's supporting that. Now, understand, that doesn't mean that I don't go long positions. I do. Our last trade was Kellogg, ticker symbol K. We did very well with that. Our members made money on that. We talked about that on Wednesday. The latest one, well, I really can't give that out, the ticker symbols that I gave out last week, because the members pay for that service. But already that last trade from last week and this week are doing extremely well. And I'm not trying to sell you on this. Folks, if you want to learn how to make money, all I can say is stickytrades.com is the place to go. And we have a stickytrades.com university where even today, one of our experts, Bob Kunkel, is putting out some educational videos on fundamental analysis. Outside of technical analysis, we do look at the fundamentals. I don't talk about them all that much because it takes more time to do that. I'll leave that up to the CNBC and the Fox Business crowd to do that. But we do use that 7-point trading checklist quite often, and I rely on it heavily. Now, real quickly before the markets close, because we're in the final 3 minutes now, I want to show you that 72% of the stocks for the S&P have underperformed the index this year. So that leaves me to question the long-term outlook of the bulls that are still coming into the market. To those folks, I would say keep your stops very tight. And this is a time where risk management is going to be needed for sure. Now, I talk about the banks quite often. You might know what's going on with the Fed and what they're doing to bail out the banks. They don't call it a bailout, but it is a bailout. They're loaning money to the banks at a low interest rate. The banks come in, they reinvest that with the Fed at a higher interest rate so they can show liquidity. But look at this chart. This is going back quite a bit to 2008, and you can see that the unrealized losses right now for the banks grew in the third quarter. So it's not getting any better for the banks, and eventually the dominoes will start going down, and you will absolutely see the rest of the market follow once the banks start taking a hit. Now, you hear that inflation is dropping. Well, it depends on what you're measuring. If you're looking at the cost of grain and rice, you'll know that this week we hit a 15-year high. So for food, which is not measured in core inflation, right? Isn't that convenient? Whenever it looks like it's going to affect the CPI or the inflation numbers, they pull it out of that index and then they replace it with something that's not so inflationary. Well, we all have eaten rice in the past or some sort of grain. This is a staple around the world, and it is going up and going up quite dramatically. You can see the angle of this trend here is breaking out into new 15-year highs. Now, in addition to that, because of inflation, the real inflation, and there's the close, 4 o'clock, right on the nose. Because of real inflation, there are many consumers that are relying on credit cards. And I know this for sure. I've had people actually tell me this, that because they're running out of money in the bank, they're using credit cards to actually buy food. Very, very scary and very dangerous. But look at the facts right here. Adults with more credit card debt than total savings is on the rise, but not by a little bit. Look at 2021, it was 21% of adults had more debt than total savings. Then it grew to 27% last year. We're ending this year with 36% of adults. We're talking over 100 million people basically have no net worth because their debt far exceeds their total savings. Now, again, this is a very dangerous position that we're seeing here because people are relying on debt, and so is our government, and that debt is still rising. You know, if the economy was doing so great, common sense tells us that people would be paying off their debt. Doesn't that make sense? Well, everyone's trying to tell us that the economy is getting better and we're going to have this soft landing. I beg to differ, and I have the evidence and the data to show that they are absolutely wrong. So be careful. You can still go long with individual stocks every now and then, and there are bearish ETFs that you can participate in that make money on the way down. But I want to show you this. This is a famous psychology of the market cycle. And what I did is I took the most current monthly chart for the S&P 500, and I just laid it side by side with this textbook example of what a market cycle looks like. This is where I see the March 2020 lows, the disbelief. Now remember, I talk about this, it's recorded on YouTube. I was going extremely bullish back when everyone was thinking the world was coming to an end. Now, I am not a never-ending bear. I just go with what I see in the evidence that I'm showing you here each and every week. And that is where we got long when everyone was selling and capitulating out of the market. Now, as we go through an extreme upswing, you see how the psychology changes. Optimism starts to creep in. Then we get another spike and rally. Then we have the real beliefs start to kick in here. Then the thrill, obviously, and then we get the euphoria. Now, it was back here. Again, go back and listen to my recordings. It was December of 2021 where I called that topping pattern right there. And we dropped significantly after that. Now, I still think we're going back down to these levels. Why? Well, look to the right of this textbook example. We are in this position right here. We're in this place of complacency. Now, I talk about the VIX each and every week. Some people say, oh, the VIX is not worth looking at anymore. Well, the VIX is a fear indicator. And when it's very low, it means there's no fear. It means investors are complacent. That's where I see us right now, right here. So depending on what happens in 2024, I think we're going to have this zigzag ABCD pattern start to form on the way down, where we'll get extreme sell-offs followed by bounces and then more sell-offs, just like I do with the ABCD patterns when I'm looking at the charts. So again, you could disagree with me, and that's okay. That's what makes a market. But please don't ignore the fact that we need to be managing risk. Now, let's go to DIA. My downside targets have not changed, but I want to show you what has changed since the midweek report. This little candle right there, although it's red, is a completed pivot point. Let me magnify that for you. We have a lower high, lower low, and with that pivot, we have the stochastic hinging lower. We have the CCI now crossed with a sell signal. Look at that blue bubble to the right. When it drops below 100, it's currently at 98.4. That is a sell signal. So we have a sell signal, hence the reason why I'm keeping that downside target on the diamonds at 365.10. Looking at IWM, you can see that we sold off today in a pretty significant way with almost no shadow right on the close. That means the sellers came in right until the bell rang, and you can see how hard they sold that right there. And then in the after hours, we still have it dropping a little bit lower. This is a misprint here, but you can see that in the after hours, we're still going lower. So going back to the daily chart, let me show you what I expect to see. Now, we are coming into the very tail end of the year-end rally, aka Santa Claus rally. And Tuesday and Wednesday ends that window because the Santa Claus rally is the last 5 days of the year plus the first 2 days of the new year. I think we're going to see some tax selling. People who are looking at their accounts at the highs but didn't want to sell today because of the tax consequence this year, they're going to most likely start selling next week so that they can defer that tax payment. I will not be surprised if we see some selling early on in the week, and then later on in the week, I believe the selling will come in more heavily. And so what happens after the Santa Claus rally? We have another cycle. It's called the January effect rally. What is that? January effect is when small caps get bought up while they start selling the large caps. This is very similar to a sector rotation. Money managers, fund managers tend to do this. They'll sell large caps and they'll buy the small caps, especially the ones that we see on the Russell 2000. So while I do believe I'll hit that downside target here and possibly even down here, I think as we come into mid-January and into February, I think we'll start to see some bounces right up until March, because that's, again, what the cycle looks like most of the time. But I'm going 1 week to the next. I'm not going to go too far out here because this is my target for IWM is 192.94. So that's IWM. Looking at the Qs, this is the most interesting chart on the board for me. I was talking about this last week with these fan lines. Let me back out a little bit. I'll just do a quick repeat. Fan lines are nothing more than lines that represent accelerated trends. We have 1, 2, 3, 4, 5. We have 6 fan lines. Now, watch as I zoom in to the fan lines, and you can see this is 9 green candles in a row. See that? 9 green candles in a row. And we have a extreme drop in volume this week, and we're closing almost exactly on that fan line. Now, this is the weekly chart. Look at the oscillators down below, starting to hinge on the stochastic, hinging on the CCI, almost the sell signal. Now I'm going to zoom into the daily chart. I call this 3D technical analysis. You could do this all day long, and I encourage you to practice looking at the charts this way. But we are right on that fan line right there. Today's close was right at 409.50, and that fan line is 409.47. Isn't that incredible? So what does that mean? I think we're going to hit that target at 397.82. And once that fan line is broken, we have a 90% chance that's going to eventually move to the next fan line in the sequence. Don't take my word for that. Go back and draw fan lines as far as you want to go. I've been tracking gaps and fan lines for 42 years, and these are the numbers that I come up with, 90%. Now, this will most likely act as a support level. Therefore, I think we could bounce. Okay, and then once we see the bounce, if it breaks out below that number 5 fan line, now we have an 80% chance that the prices will drop to the next fan line in the sequence, which would be fan line number 4. So keep an eye on that. This is being recorded for good reason, because I go back to show the evidence of what's happened with these charts. So it builds a confidence level in our members as they look at the charts themselves. So again, I think we're going lower. Keep an eye on that target. Keep an eye on that moving average. I think we're going to have a very interesting couple of weeks ahead. Now, SPY, and we're going to wrap up soon here. We have a pivot point on SPY as well, lower high, lower low. Look at the increase on volume on that pivot point. That's interesting because we have a sell signal on the stochastic here. We have a sell signal that occurred yesterday on the CCI here. So downside target is still in place right there at 450.18. Now finally, the VIX. I was talking about this earlier on those slides. Last week I said that there was a good chance we would breach that, but then I said we would most likely pivot up from it. So we have breached it. Look at the momentum starting to shift up on the VIX. I'm keeping that upside target right there at $18.11. This is an inverted hammer right there. I'll magnify that for you. It's a inverted hammer, which is bullish. And so I'm keeping that upside target in place. Once the VIX starts to heat up, what happens? Emotions start to heat up. Investors start moving out of complacency, out of that relaxed mode of thinking, and then they start to get more defensive. Folks, thank you so much for sharing our channel with your friends and family, especially on social media. We're growing our subscribers on YouTube by 1,500 new subscribers each and every month. And so that's going to accelerate because the more people who follow us, the more that will share. And the more who share, the more momentum we pick up on views. When you like that button all the way to the right side of your screen right there, when you like that button, it puts us in the algorithm. And when you make comments, that helps us as well. And when you hit that notification bell at the top, you get notified when the videos are released, and that gets us on the main menu for YouTube. And that's why we're able to get some new eyes on our videos, because of you sharing, liking, subscribing, and commenting. Have a very, very happy new year, and I'll talk to you next week. So long.